Understanding the BofA US High Yield Index Option Adjusted Spread and its implications for the economy. Part 1/2. Introduction. A brief explanation of the BofA US High Yield Index Option Adjusted Spread. The BofA US High Yield Index Option Adjusted Spread is a financial indicator that measures the yield difference between high-yield bonds and a comparable risk-free investment, typically U.S. Treasury bonds. High-yield bonds, also known as junk bonds, carry a higher risk of default compared to investment-grade bonds. The spread represents the additional yield that investors demand for taking on the added risk associated with high-yield bonds. Specifically, the BofA US High Yield Index is a widely followed benchmark that tracks the performance of US dollar-denominated high-yield corporate bonds. The option-adjusted spread takes into account the potential changes in cash flows due to embedded options in the bond contracts, providing a more accurate measure of the risk premium demanded by investors. Importance of understanding the spread and its role in assessing the economy. The spread serves as an important indicator for assessing the health and overall sentiment of the economy. It reflects the market's perception of credit risk, investor appetite for risk, and prevailing economic conditions. Understanding the spread can provide valuable insights into the current state of the economy and help investors, policymakers, and analysts make informed decisions. The spread's movements can signal changes in market dynamics, such as shifts in investor sentiment, liquidity conditions, or economic expectations. A widening spread indicates higher perceived risk and potential economic weakness, while a narrowing spread suggests improving economic conditions and reduced risk perception. Moreover, the spread analysis can help identify potential investment opportunities and inform portfolio allocation decisions. By monitoring the spread, investors can assess the relative attractiveness of high-yield bonds compared to safer alternatives and make informed judgments on risk-reward trade-offs. Additionally, policymakers and central banks closely monitor the spread as part of their efforts to gauge the health of financial markets and the broader economy. Changes in the spread can influence monetary policy decisions, corporate borrowing costs, and overall financial stability. Defining the BofA US High Yield Index Option Adjusted Spread. Explanation of the High Yield Index. As discussed before, the BofA US High Yield Index is a widely recognized benchmark that tracks the performance of US dollar-denominated, non-investment-grade corporate bonds. These bonds are issued by companies with lower credit ratings, typically below investment grade, BBB or higher. The index includes a broad range of industries and sectors, providing a representative sample of the high-yield bond market. The index constituents are selected based on specific criteria, such as issue size, liquidity, and maturity. It is market value-weighted, meaning larger and more actively traded bonds have a higher impact on the index's performance. The BofA US High Yield Index serves as a reference point for assessing the performance and risk of high-yield bond investments. Definition and calculation of the option-adjusted spread. The option-adjusted spread, OAS, is a measure of the yield difference between the BofA US High Yield Index and a comparable risk-free investment, example, U.S. Treasury bonds. The OAS takes into account the potential changes in cash flows due to embedded options, such as call options or put options, in the bond contracts. Option-adjusted spreads are calculated by subtracting the yield of the risk-free investment, such as a Treasury bond, from the yield of the high-yield bond index. The yield of a risk-free investment represents the minimum return investors expect without assuming credit risk. By subtracting this risk-free rate from the yield of the high-yield index, the OAS quantifies the additional compensation investors require for taking on the credit risk associated with high-yield bonds. The option-adjusted spread offers a more accurate measure of the risk premium demanded by investors compared to a simple yield spread. It takes into consideration the potential impact of embedded options on the bond's cash flows, providing a more comprehensive assessment of the risk-reward profile of high-yield bond investments. Significance of the spread in assessing risk and market conditions. The option-adjusted spread is a critical metric for assessing risk and market conditions in the high-yield bond market. It serves as an indicator of the compensation investors demand for taking on the credit risk associated with non-investment grade bonds. A widening option-adjusted spread suggests an increase in perceived credit risk, signaling potential economic weakness or market stress. It indicates that investors are demanding a higher risk premium for holding high-yield bonds compared to risk-free investments. This widening spread may result from factors such as deteriorating economic conditions, rising default expectations, or increased uncertainty in the financial markets. Conversely, a narrowing option-adjusted spread suggests improving market sentiment and reduced credit risk perception. It implies that investors are willing to accept a lower risk premium for holding high-yield bonds, indicating stronger economic conditions or increased investor confidence. Monitoring the spread can provide valuable insights into overall market sentiment, credit risk appetite, and investor expectations. It allows investors and analysts to assess the relative attractiveness of high-yield bonds compared to safer alternatives, evaluate market conditions, and make informed investment decisions. Furthermore, the spread analysis can help identify potential opportunities for arbitrage or relative value trades. When the spread widens excessively, it may present opportunities for investors to purchase high-yield bonds at more attractive prices, expecting the spread to narrow in the future as market conditions stabilize. Interpreting the spread, what it says about the economy. Historical trends and correlations with economic conditions. The ICE BofA U.S. High-Yield Index Option-Adjusted Spread has historically exhibited correlations with economic conditions. During periods of economic expansion and favorable market conditions, the spread tends to narrow. This narrowing reflects increased investor confidence, reduced credit risk perception, and a higher willingness to take on risk in search of yield. Conversely, during economic downturns or periods of market stress, the spread typically widens. This widening indicates higher perceived credit risk, lower investor confidence, and a flight to safer assets. The historical trends of the spread can provide insights into the economy's cyclicality, market cycles, and the general risk appetite of investors. Relationship between the spread and overall market sentiment. The spread plays a crucial role in reflecting overall market sentiment. When market sentiment is positive and investors are optimistic about economic prospects, the spread tends to narrow. This narrowing indicates a higher demand for high-yield bonds, as investors are willing to accept lower risk premiums in pursuit of higher returns. Conversely, during periods of market pessimism or uncertainty, the spread widens as investors become more risk-averse and demand higher compensation for holding riskier assets. The spread's movement, therefore, can provide valuable insights into the prevailing market sentiment and investor risk appetite. Indications of economic strength or weakness based on the spread. The ICE BofA U.S. High-Yield Index Option-Adjusted Spread can provide indications of economic strength or weakness. A narrowing spread suggests improved economic conditions, as it reflects lower perceived credit risk and increased investor confidence in the economy. It indicates that investors are more willing to allocate capital to riskier assets, such as high-yield bonds, in search of higher returns. On the other hand, a widening spread may signal economic weakness. It suggests that investors perceive higher credit risk and are demanding a higher risk premium for holding high-yield bonds. A widening spread can be indicative of deteriorating economic conditions, higher default expectations, or increased uncertainty in the economy. Factors influencing the spread's movement. Several factors influence the movement of the ICE BofA U.S. High-Yield Index Option-Adjusted Spread. Economic indicators. The spread can be influenced by economic indicators such as GDP growth, employment figures, inflation, and interest rate expectations. Positive economic data and expectations of economic expansion can narrow the spread, while negative data or economic uncertainty can widen it. Default risk. The spread is highly sensitive to changes in default risk. Factors such as corporate earnings, debt levels, credit ratings, and overall market conditions can affect default expectations, thereby impacting the spread. Market liquidity and investor sentiment. Liquidity conditions and investor sentiment play a significant role in the spread's movement. During periods of market stress or reduced liquidity, the spread tends to widen as investors demand a higher risk premium for holding high-yield bonds. Central bank policies. Monetary policy decisions and actions by central banks can influence the spread. Changes in interest rates, quantitative easing measures, or other policy interventions can impact investor expectations, risk appetite, and ultimately, the spread. Supply and demand dynamics. Supply and demand imbalances in the high-yield bond market can impact the spread. If the supply of high-yield bonds outweighs investor demand, the spread may widen as investors demand higher compensation. Conversely, if demand outpaces supply, the spread may narrow. By considering these factors and analyzing the spread's movement, economists, analysts, and investors can gain valuable insights into the current and future state of the economy.